day friends. In the subject of personal financial planning, today I will be talking about insurance planning. When we are talking about the personal financial planning or financial planning, unless you make your insurance planning, your whole program of the financial planning may get disturbed because of any uncertainty, any risk that arise in life. For that purpose, insurance planning is very, very important. Life is full of uncertainties and risk. It may be a risk of life. It may be a risk of your health. When I am talking of your health, it includes your family's health, health of your spouse, health of your dependent children. It may be risk of any accident, any property damage, or any financial loss can take place. So, it is very important in life to have proper risk management system in order to have a sound financial planning. So, insurance is a very important subject which all of us must understand properly for the financial planning as an individual. We must know what are the different types of insurance which are there, how you can manage your risk through insurance, what insurance is all about, what are the basic principles of insurance, and the benefits that arises because of the insurance. We must understand all these things. So what it means is that people are exposed to different type of risk in their daily lives, since life is full of uncertainties. You never know what is going to happen tomorrow. Today you are having a good life, in healthy life. Tomorrow any illness, any ailment can take place, and there may be a need of emergent hospitalization for which you may have to incur heavy medical expenses. Insurance as a financial planning tool can save you from financial crisis in case of any unforeseen circumstances. One of the unforeseen circumstances I have just referred, you are going with a laser in your car, and suddenly, not because of your fault, because of the fault of the other, because of the other's mistake, an accident can take place, and it may damage your car, or it may impact even your own body, right? For that, there may be a need of hospitalization of you and your family, and there is a need of the heavy expenditure on the repair of the car. So this is unforeseen circumstances. Any unforeseen event has happened, and for that you have to spend heavy money. How you will manage that? Your life savings which you have accumulated over a period of time will be spent in your medical expenses, and will be spent for the repair of your car if there is a major accident. So for example, your health insurance policy will cover the medical. So what you are required to do is take a medical health insurance. I will be talking of all these things in detail in the full lecture of today. So your health insurance policy will cover the medical cost for hospitalization if you meet with a car accident and need to be hospitalized. As I just said, that if an accident takes place, and in that accident you need to be hospitalized. You, when I am using the word you mean, it means your spouse or your dependent children, right? And a heavy cost has to be incurred on that, or medical expenses. Your car insurance will pay for the damage of your car, providedly you have got your car insured. So if you have a family, insurance is even more crucial as a way for you to meet your obligations. Means when I'm using the word when you have a family, it means if you are suppose single, means you don't have a dependent children, you don't have a spouse, you are not married. So still you need risk management system. But if you have a dependent persons, dependent parents, dependent children, then the need of the insurance is even more. So your family will receive a lump sum amount for your term insurance in case a person dies in an accident. No matter how healthy you are, or how well you are doing financially, or how good a driver you are, you need insurance. Means, I know that I am a very good driver, I drive my car very safely, but not your fault, but because of some other's fault, an accident can take place, which may damage your car, which may impact your body, right? So an accident, there may be anything, a fracture can take place or anything can take place. So this is because of the simple fact that insurance acts as a safety net which financially protects you and your family during financial hardship. Means when you have to incur heavy expenses on these various things which I have just referred, right? If there is an insurance policy, I'll be talking about this insurance policy and what this insurance is all about. So if you have an insurance policy, the insurance company will take care of your expenses which you will be incur in the hospital or which you will be incurring in for the repair of the car. So many of us thinks that insurance is an unnecessary expense. The reason is that we feel confident about our future and our ability to tackle unforeseen events. We always think that we know what are the unforeseen events that can happen, and we have provided enough money for it. But no money is enough if there is a great damage or great loss that takes place. Even if you have the money, but you will find the pressure on your plans, your financial plans. You want to construct house, you want to go for the foreign trips after the retirement, and whatever you have saved in the last 10-15 years, that may be incurred. But if you're properly insured, your car is insured, your health is insured, means you have taken a medical insurance, then the medical insurance will take care of your medical expenses. The car insurance will take care of the damage of the car which has taken place, right? So however, there is a huge difference between our perceived ability and reality. What we think is possible and what happens in the practical life, there is a difference. Recently the worldwide COVID took place, COVID-19, right? This pandemic has proved that any uncertainty can happen with the life or with the people. So a lot of people lost their jobs during COVID-19, right? Pandemic. A lot of people died also, and they were remained at home, so their business was being impacted to a great extent. So they were not able to meet out their even day-to-day expenses. So for all these things, you can have an insurance policy. So you need insurance if, what you require, why you require insurance? To pay cash to repair or replace your vehicle if you met an accident. You repair your own home in the event of a fire, damaged window, floods or a hailstorm. Means any natural calamity can take place which leads to flood, there may be in form of floods, there may be in form of hailstorm, which can affect your property, which can affect your home, which can affect your other property, right? For repair of that, you need heavy expenses. To pay cash for adequate medical facility even in the event of illness or injury, I have already referred. Your family needs your income to survive. Suppose something happens to an individual, and after the demise of that individual, the family needs money. If the person is the only earning member of the family, and if something happens to the earning member of the family, then for survival, that individual's family need money. But if the insurance cover has properly been taken of the adequate amount, then the insurance company will pay the amount insured, and the family can at least have a day-to-day life or the financial, not there is much financial burden on the family, right? So you want to reduce your financial burden in case of a suit. Suppose sometime we can take an insurance policy that if there is a suit takes place, if there is a court case takes place, in the court case, these days the lawyer's fees and the other expenses of the court has gone up. So you have to spend a heavy amount on the court cases. That is, for that also you can have a insurance policy that in case there is any suit arises in the business, in your personal life, for that you can claim to the insurance company that this much money is needed. Up to the insured amount, the insurance company will pay you. So thus, buying insurance is a crucial part of sound financial planning. So let us understand what is the meaning of insurance. So friends, what I am saying is that you need proper insurance for proper financial planning, because we are discussing the subject of financial planning, and in the subject of the personal financial planning, each one of us must understand that there must be a proper insurance planning for the proper financial planning. So what insurance is we mean? What we mean by insurance? So insurance is the equitable transfer of risk of loss from insured, that is a policyholder, to the insurer, that is insurance company, in exchange for certain payments which is known as premium. So what it means is that there are two parties involved. One is the insured, other is called the insurer. Insured is the person who gets the insurance. Insurer is the company or the organization which gives the insurance to the other party, right? And both have their consideration. The insurer will get a premium. Insured will have to pay the premium for the unforeseen event, unforeseen circumstances that may take place in the future, and if there is any loss of property of the state or of the health, of the medical expenses or of the person, then the amount insured will be paid by the insurance company to the insurer. So in exchange of a certain payment, the risk of the individual or risk of the insurer is being transferred to the insured. So it is a form of risk management where the insured assumes a guaranteed and relatively small certain amount by way of payment to the insurer in exchange for the insurer's promise to indemnify the insured in case of financial loss. That is, the insurance company promises to indemnify the loss, financial loss, right, that takes place because of any event, and the insurer is being paid to the amount of the insurance. To indemnify means to pay somebody an amount of money if he or she suffers loss or damage, or to be reinstated to the position that one was in to the extent possible before happening of a specified event or peril. What it means is, as I said earlier, the insurance company promises to indemnify the loss. Suppose I am running a business and I am running a, say, shop, Kirana merchant shop, in which there are goods worth 10 lakh rupees, stock worth 10 lakh rupees. So supposing a fire takes place and all the goods is being damaged in the fire, right? Fire has broken in the shop and all the goods are being lost. Supposing I have got the insurance for the goods to the extent of 5 lakh rupees or 7 lakh, whatever the amount may be, right? In that case, the insurance company will pay the extent of loss. The extent of loss, because my insurance is of 5 lakh rupees and the loss took place of 10 lakh rupees. So the insurance company is not going to pay 10 lakh rupees. Insurance company will indemnify the amount of the insurance which I have taken. Since I have taken an insurance policy of 5 lakh rupees, that is, if any fire takes place and because of the fire, if any loss of goods takes place, so 5 lakh rupees will be paid by the insurance company. So I have got my goods insured from the insurance company to the extent of 5 lakh rupees. In that case, the insurance company will pay only 5 lakh rupees, not the full 10 lakh rupees. Supposing the 50% of the stock is being lost. So goods is worth 10 lakh rupees and the 50% of the stock is less. The company is not going to pay me the full amount. Company is going to pay me only 50% of the amount. So means at least the risk will be transferred from the person who has taken the insurance to the insurer who has insured, that is the insurance company. So insurance policy is a contract which outlines the conditions and the circumstances under which the insurance will financially compensated, right? The insurance will be financially compensated as per the terms and conditions of the insurance. See, while you take a policy, there are certain conditions, there are certain rules, regulations, there are certain conditions which both the parties have to abide. And as per the insurance policy, whatever the terms and conditions are, it is binding on both the parties. That is the insurance company as well as the person who is insured. Now, insurance can be broadly classified in two categories. One is called the life insurance, other is called the general insurance. There are many types of insurance. I am not talking of that at this moment. Broadly, I am saying the insurance can be categorized in two categories. At this stage, I am saying that insurance can be categorized in two categories, life insurance and general insurance. What is life insurance? Life insurance provides a financial payment to the policyholder or her nominee upon the death of the policyholders or after the expiry of a fixed period. When you buy a life insurance policy, you name a beneficiary. It is generally recommended to purchase an insurance with coverage worth 7 to 10 times of your annual income to protect your family. Let's understand what is life insurance is. As I said in the beginning of my lecture, life is very uncertain. Anything can happen to any person. People think that they will never die, but everybody has to die at one point of time or the other. It is a hard fact of life. There is no prescribed age when a person will die. Some people may die at 10, 20, any age, anything can happen, right? So what people can do, that you take a life insurance policy. You pay a premium, a certain sum of money every year to the insurance company, that is called the insured. So it means if when you are taking the policy, you will be called insurer, and you take a policy from the insurance company, that is called the insured, right? So the company which is making the insurance, you are making an agreement between the company and the individual. Suppose the individual is taking the life policy, right? That each year, or as the terms and condition may be, it may be monthly, it may be quarterly, it may be biannually, a sum of money will be given by the individual to the company, right? So the insured will pay sum of money to the insurer. A premium will be paid. That sum of money is called the premium for a period of time. Say for example, if a person is of 25 years of age, he takes a policy of say 40 years. That up to the 65 years of age, the person will keep on paying the money, right? Premium every year. Suppose an annual premium policy is being taken. So every year, a person will pay the premium, sum of money, small sum of money to the insurance company, right? Supposing something happens to that individual before the age of 65, right? Then the policy, as per the terms and conditions, suppose a person, when the person's age is 25, gets a policy, 40 years policy, and suppose something happens in the age of 30 only. When after 5 years of the policy, something happens to that person. So whatever the amount of the insurance is, suppose the insurance was of 1 crore rupees, right? So at the age of 30 itself, the insurer's nominee, means the individual who has taken the policy, his or her nominee means the beneficiary, will be given 1 crore rupees by the insurance company. Presumably nothing happens to that individual, and that individual survives up to the age of 65. Then at the age of 65, when the person is still surviving, the policy amount, right, that is called maturity amount, because there are different type of policies. I am not speaking about that at this moment, but a sum of money, that is the 1 crore rupees, suppose the policy is of 1 crore rupees, the maturity value of the policy is 1 crore rupees. So 1 crore rupees will be transferred to that individual. So throughout the 40 years of life, he keeps on paying an annual premium, right? And as and when the person will become, because the policy is of 40 years and the policy holder has taken the policy in the age of 25. So once the person becomes of 65 years of age, then the policy amount will be given to that individual, right? Supposing the person is retiring in the age of 65 or 60, right? So I'll take a policy in such a manner that if I'm starting my job in the age of 25 and I will be retiring in the age of 60, so what I will do is that I'll take a policy of 35 years, that if something happens to me before the age of 60, suppose in the age of 30, 35, at any point of time, then my dependent, my spouse or my dependent children will get this whole sum of money, the full 1 crore rupees. Means no premium is required to pay in future, and the whole policy amount will be given to the dependent, so that they can have they can meet out their financial obligations even if I am not alive in the world, right? The individual is not alive in the world. And if nothing happens in the age of 60, the person will get the money. So it will be like a retirement. At the time of retirement, the individual, when the regular income is not there, from that insurance policy amount, the maturity amount which the individual will get at the time of the maturity of the policy, the individual will get the sum of money of 1 crore rupees. So when you buy a life insurance policy, you name a beneficiary. As I've said already, a beneficiary name, and the beneficiary is normally the nominee or beneficiary. It may be in the name of your spouse, it may be in the name of your dependent children, or it may be any person whom you nominate. So it is generally recommended to purchase an insurance with coverage worth 7 to 10 times. See, it's only a suggestion that each individual, it is being suggested by the financial planners that each individual should take 7 to 10 times of your annual income, so that if anything happens to that individual, the dependent children can have, or the spouse, if the person is the only person who used to earn, right, can have the same standard of living even after the death of that person, right. So it is just a advisory that 7 to times of your annual expenses should be taken as a protection for the life policy. The other is called general insurance. General insurance is other than the life. Such items cover policies which are not directly related to the life of the individual. Such policies insure the policyholder against the risk of wealth and health. I am taking a health insurance policy. As in the beginning of this lecture, I was saying, any illness, any ailment can take place, and for that the medical expenses or the hospitalization is required, on which I have to spend a heavy sum of money on the medical care, right? Or your dependent children, or your dependent spouse, or anybody whom you are having considerable interest, right? For meeting out those financial obligations, medical expenses, you can take an insurance. You are having a car, you are having a house. Any fire can take place in the house, any burglary can take place in the house, right? Or any natural calamity can take place out which may damage your property. So in that case, you can take a insurance policy that if anything happens in the house, any loss of property takes place, right, because of any reason, the insurance company will take care of this. For which you will have to pay a fixed premium annually, right? So unlike in the life policy where you get the money even if nothing happens to the individual, I said when I was talking of life insurance that if you have taken a life policy of 35 years, right, in the age of 20, as in when you will get the age of 60, you will be paid a sum of money assured, right? But in case of this general insurance, no money is being paid, right, at the time of maturity. Suppose I am taking say fire insurance of my house of 1 year. I have paid a premium for 1 year. So if within that year something happens, right, if fire took place at my home and some loss of property takes place, that the insurance company will take care of it. Insurance company will reimburse the loss that will take place, providedly the loss is within the limit of my policy. That if I have taken a policy of 10 lakh rupees of right, so if the loss takes place of 10 lakh up to the extent of 10 lakh rupees, the insurance company will take care of it. But if nothing happens in the whole of the year, nothing happens to the house, no fire took place, so the premium which I have paid, right, that you should treat it as an expense against the loss that may arise, that may happen, that may not happen. So what I am trying to say by this is that in case of life insurance, like if nothing happens to the individual up to a period of time, means up to the span of the policy period, then the individual gets the money. But in case of general insurance, nothing is being paid if no loss took place, right? So such policies insures the policyholder against the risk of wealth and health. Health in the sense medical insurance, wealth, it may be fire insurance, it may be marine insurance, it may be any type of insurance, any natural calamity take place. So any damage to the property or to anything for which you have taken a insurance policy, right, then the insurance company will take care of it. Now after talking of this general insurance, the life insurance, you must have understood that insurance is important for all of us. See, insurance is not a business of profit. It is for the person who is taking the insurance. It is basically a risk management. that by insuring your property, by getting your life insured, by taking a health insurance, if any financial obligations arises or financial loss takes place because of the loss of property, loss of health, then some part of it, means when I am using the word some part of it, to the extent of the amount of the policy, the insurance company, which is known as the insurer, will take care of that financial loss that has taken place. So, I will be continuing this insurance and the principles of insurance and other aspect of the insurance planning in my next lecture. So, once again, let me reiterate that insurance planning is a very important and integral part of the personal financial planning. Thank you.